Good morning, everybody. We'll kick off. We still have a couple of people joining, but we'll try and get the morning going so that we can finish up on time for you. I'd like to welcome you all to our webinar this morning and thank you for taking your time out. My name is Jillian O'Sullivan and I'm the partner in Grant Thornton leading our Employer Solutions offering. We will have three speakers with us today. We have Michael McKiernan, who's going to cover the topic of developing a strategy around returning to work and adapting to new ways of working. Jane Quirke, who will be looking at the closure of international borders and the travel restrictions and how this has impacted some employees and the need for remote working. Debbie Fry will then help us look at supporting our employees in understanding their personal finances and ensuring they can look at how to improve their financial wellness, especially with the current worries and unknowns that surround us. Each session will be about 10 minutes, and this will then leave us for time for questions at the end. However, as we go along, please feel free to pop questions into the chat boxes, and we'll do our best to cover them all for you. Hopefully, we'll still get you back to your day job on time. I'm now going to pass you over to Michael from our People and Change team.
Good morning, everyone. My name is Michael McKiernan and I lead our People and Change practice. If we just go to the next slide, thank you. Where we help organizations work with their most important asset, obviously their people. We help them build that capability, lead change and engage their people. Now, over the last few months, there's been a big toll taken on the bottom line of our people and both leaders and employees have adjusted well to ever-changing circumstances. We were thinking about how we were going to help clients get back to work and decided that we didn't necessarily want to return to the new normal, but rather we wanted to help them get back to better. So today I thought it would be good to share with you our approach and take you through 5 distinct changes that your people will go through and the leader's role specifically in that. There are some specific examples you can do in some critical stages around what we have called the honeymoon and integration stages and share with you some practical tips that we've used in Grant Thornton. I will cover as much as I can in the time available, but we will focus on those 2 areas. And if you have any specific queries or more information, contact details will be provided at the end. If we go to the next slide, please. So as we start to look around potential impact on performance, performance is impacted by change. And when people get distracted about what's happening around them, they have unclear, confused, they feel insecure. But when change is executed well, it can also have a very positive impact. And as you can see there, if it's approached thoughtful in planning and meaningful engagement, this can be a chance for organizations to build back better. Next slide, please. So as you think about it, all of us, including your own people, are on a journey, and it's important that we're empathetic and appreciate how your people are feeling at each stage. In this, we see clear 5 phases, which is anticipating what's happening with the change, the honeymoon period, the integration period, the performance piece, and then finally growth. And the anticipation piece, which most of us have probably already gone through now, it's all about getting the planning right, and it's getting into the detail. The honeymoon is where everybody's maybe starting to get excited about being back in the office, seeing their colleagues and seeing what's familiar around them. What's important in this stage is communicating the steps on how to return safely to the office. And that's all about the communication piece. And what we've actually seen with some organizations over the last couple of months is they had maybe put out a statement saying that they weren't looking for anybody to be back into the office maybe to the end of the year. And now they're asking people to come back in. So it's creating a little bit of that uncertainty again. So it's really important that we start to look at how you're doing that and being very clear on communicating that vision as you go into integration. We then start to look more at performance, and what we're starting to see is there's a bit of a potential risk of a gap happening in performance as people start to come back in because things are starting to plateau. The new normal of working from home, whether that's from the kitchen table or an extra bedroom or somewhere in another part of a 2-bedroom apartment, people need to start to think about how they'll be doing things differently. And so there's a big focus on reskilling. And then the final stage around that is starting to think about growth. And this is very much starting to think about how we empower our people to take advantage of new opportunities, embrace the new ways of working, and to think about what that looks like. Next slide, please. So as we start to look at this, as you can see, the 5 stages are laid out, and focusing today on the integration and honeymoon period. The green area in the middle starts to represent a performance gap that you want to start to avoid. And depending on how you start to integrate and bring people back into the office and how you start to deal with that honeymoon period will allow us to look at that in more detail today. I will be focusing primarily on the integration and honeymoon period and specifically around some key topics to make sure that these are probably where you're finding yourself in your own organizations at the moment. Next slide, please. So interesting enough, all of us in a matter of days were pushed out of our offices and put into houses, and the first couple of weeks, everything was about making sure people had the right equipment, the right tools, the right technology, the right setups at home, whether it was family commitments, etc., to be able to do their own, to be able to do their work. And what we started to then look at is starting to understand what trust would look like as part of that. And we've been working very much around this concept around cost, which is saying that, look, there should be some very clear expectations on how things should work. We need to think about what we mean by output over hours. So what used to typically happen was people were in the office from 8:30, quarter to 9 to 5:30 or 6, and you could see what people were doing, and it was a bit easier to set goals and touch base and have a quick coffee to make sure things were being met. But that's now something that needs to be done over the phone or over Zoom. Also staying engaged. What does it really look like now to look at staying engaged and then also being transparent? Because there's a bit of a nasty trap that could be caught in transparency, especially if managers feel that employees might be sitting and watching TV rather than getting their work done. And there's some changes in mindset here that we need to look at. So I'd just like to take you through a couple of slides to show you how that works. So if we could go to the next slide, please. And that next slide very much is looking at that piece around clear expectations. So organizations transitioning back into the office have pretty much almost all of their employees now working remotely. Setting clear goals with them and expectations in order to develop trusting relationships is even more important. And this is coming back to this idea around what are people doing on a day-to-day basis? Are we setting clear deadlines for deliverables for projects and in operations? Have you set up a series of consistent touch points, or what we like to call a cadence, where you might be having a quick 5-minute huddle every day, whether in the morning or the afternoon, okay? And one of the things that we've been finding both with clients and ourselves over the first piece is we're not spending enough time or setting enough time aside to have the expectations in the performance conversation. So sometimes there's an assumption of what expectations are and what deliverables are, and those are then taken away as an assumption without being cleared with the manager. Next slide, please. There's also then a whole piece around focus switching to output rather than input, because you can't see what people are doing in the office, and you're not understanding what they're doing with every minute of their work. And there's something around people and performance and what employees have to show in flexible circumstances. So different adjustments that have had to have been made by managers included new forms of trust in how they accomplish what's agreed. Organizations are now empowering even employees to manage their own time and productivity better. So I know of certain both staff members within Grant Thornton and also within clients that might be working an early day, and then their partner will be working almost a second shift, a later day, in order to help manage childcare. Employees are also being held accountable to deliver while communication is being made if they fail to deliver, so they can explain. So it's getting over that piece, which is I'm not sure how to do this, or I don't have enough time to do this, and therefore instead of being able to go up to the desk and having the conversation, actively reaching out to make sure that happens. A couple of changes for us as managers and leaders. We have to adjust and understand that we're not tracking time as by seeing how long somebody is in their seat and how long they're doing their work from 9 to 5. And employee monitoring has proven to impact productivity and lower morale negatively because people do not feel that they're being trusted. Next slide, please. If we then start to look at staying engaged, this is interesting enough through quite a lot of organizations. The remote environments has forced organizations to innovate even, their traditional engagement channels. And what we've started to find is a lot of organizations have been very good at this as regards to being able to create online forums, Microsoft Teams, maybe even the odd Zoom pub quiz on a Friday. But other things they've needed to do is have public recognition that is taking place to improve morale, to actually go out and show what people are doing. A lot of pulse surveys around COVID-19 have been happening, and leaders have been utilizing those to engage with the organization needs and flexing. A lot of information is being shared across teams and increasing touch points. So things like Microsoft Teams, some of the different collaboration tools have become really, really useful. And organizations are also now providing more regular feedback on virtual platforms. So quite a lot of our clients, and even ourselves in Grant Thornton, when the pandemic first started, we're having weekly emails coming out from senior leadership. We were doing video logs to show different things happening. We were having touch bases with teams. And what that did was create a sense of engagement, because the cascade was coming down people to people. The other piece that is really important here, and out of one of the other learnings, in addition to faster information, is people were using more video. So that idea that people can use video and really be engaged has been important, but also that point there, faster information was withheld from employees until the last minute. So the employees were starting to feel that there was something that they thought they should have known, and they were questioning why it was holding it back. So we need to think about how we're getting the right information out as fast and as timely as possible in order that employees can react. Next slide, please. And the last and probably most important piece around the honeymoon or integration phase is this whole idea around adapting to transparency around operating. So, you know, as I said before, you know, managers fear that their employees might be sad by the TV in their pajamas, or munching on snacks, or, you know, they're watching a Netflix video rather than doing the work. And we really need to think about how we're getting information back regarding expectation, tasks, and deadlines. So as long as we're clear about that. The other piece is being open and transparent with strong communication. So understanding what people's situations are and having that ways of working conversations so people understand where they are, what they're doing, and how to do it. And remote employees are now feeling trusted and valued again, because there's more engagement, not necessarily about overseeing what they're doing, but making sure they have what they need in order to take that forward. Initial poor transparency, there was a lot of micromanagement at the beginning, and that has relaxed because it's reducing, it needs to be reducing productivity paranoia. So people are spending more time worried about what they're getting done rather than actually completing it. Next slide, please. So I guess just to wrap up on my side, there's something here around balance, and that's balance on a whole series of levels. If we could go to the next slide as well. There's actually been some research done on this now, looking at how things are shifting around performance and shifting around preference. And this is a study done out of NUIG, and it's really starting to look at, you know, employees are taking on new roles, and they are very much looking at things and having skills that they've never trained for. Yeah, managers are showing more flexibility as regards to allowing individuals time to learn and be able to perform and understand things, and that the mistakes will be made and hiccups are happening. And people are learning new skills that they never knew they had through technology and digital communication. Now, what that has started to show us is 51% of employees that were surveyed had never worked remotely before COVID. 78% of that group want to continue to work post-COVID remotely. 85% somewhat or strongly agree that their organization is doing the best in the circumstances, and 37% of that report that it's difficult or somewhat difficult to work virtually. So what we're starting to see is there's that shift in performance, but at the same time, there's also the shift in preference. And I'm not sure if anybody heard yesterday on News Talk, IBEC had come out and is actually putting up a hand as a bit of a warning to say, we actually need to start to encourage people back into the offices to make sure they feel safe and that they can work there, because some of the smaller microeconomies around the office buildings and in some of the city centers will also begin to collapse if the levels of people coming back into the office are not at a sustainable level. So that's a bit of another interesting impact that we're moving into now as we start to go from honeymoon and integration into performance and growth. Next slide, please. So just to wrap up quickly before I hand over to Jane. Over the last 9 weeks, we've learned a couple of things. One, communicating with staff is key. the more we can talk to them, and the more we can let them know what's going on, the more apprehension seems to disappear. In particular, people don't mind the red tape, and what we're talking about here is the whole concept of how they're getting back into the office, and maybe some of the hurdles and some of the paperwork and things that they need to do in order to do that. There's been a slow trickle back into the office. I don't think we'll ever get back to 100% capacity, but there does seem to be more and more people coming back into the office, and I think probably most of us will be working a 2 to 3 day week in the office and a 2 to 3 day week back from home. Collaboration has worked to date, but Zoom and Skype fatigue is now setting in. I don't know about yourselves, but after 8 hours on video calls, the last thing I want to do is to talk to somebody else. We need to ensure we can collaborate and engage employees while working remotely still. Some people are not in a position to come back. And what I mean by that is it might be a childcare challenge, or it might be a family member who's vulnerable to COVID. So there's something around thinking about how that challenge can be dealt with in your own organizations, and that could be different for each one. Spontaneity, groupthink, communications, more formal remotely, you can't read body language. So starting to think about even having that video piece to piece, there's something really important that needs to happen around that. And there's now really very much a need to focus on business as usual. So, you know, maintaining performance, and what we're starting to see with certain clients is thinking about new ways of working and how we can be flexible and how we task and lead performance, because we do see a gap coming in as that fatigue sets in. And then last but not least, growth can still happen, but in many different ways. And we just need to repivot what your offerings are and what your new offerings are emerging, and thinking about the things that have worked well for you and are going to be the things that help you continue to return to growth. So next slide. Thank you very much. I'll now hand over to Jane, and she'll take you through remote working from her perspective. Thank you.
Good morning, everyone. My name is Jane Quirke, and I'm a tax director in our Employer Solutions team. Given the cross-border travel restrictions, even border closures in some countries, many employees are now working remotely in countries where they ordinarily would not have been working for such long periods. This has created a huge range of tax complexities for employers, which I'm going to explore in this short presentation. Next slide, please. So these are some of the typical scenarios we're advising employers on at the moment. We have Irish-based employees who would normally have been working in Ireland, been stuck overseas and unable to return. We have employees choosing to move country during the pandemic. Often that's to a home country to be with their family. We have Irish-based employees who were working abroad on a short-term basis but are unable to return, which is leading to assignments being extended. We have Irish employees who would normally be working abroad, moving back to Ireland to sit out the pandemic. And then we have employers who've had to move employees to different locations during the pandemic. Next slide, please. So what does all of this mean from a tax perspective? So I'm going to group the scenarios from the previous slide into two groups. So the first group being the employees who now find themselves working abroad for longer periods for whatever the reason, and the second group being those who now find themselves back in Ireland. So for those employees who are working remotely overseas, the question arises as to whether the Irish company has an obligation in the foreign country to operate foreign payroll withholding tax and to set up a foreign payroll. For those of you who have some familiarity with foreign payroll withholding tax obligations, you'll know that that obligation can arise from employees spending relatively few days in a foreign country, despite the 183-day rule that applies under double taxation agreements. Social security can be a real issue for companies where employees are working outside of Europe. And while Ireland has an extensive double tax treaty network, we really only have a small number of bilateral agreements with other countries. So what that means is that where you have employees working in new country locations, it can trigger additional social security liabilities, both for themselves and the employer, which can be very high. And finally, depending on the type of work and the relevant tax treaty, these newly remote employees could be creating a permanent establishment, which is a taxable presence in the countries where they're working from. And if companies can't avoid that situation, it can lead to unwanted outcomes like misfiling requirements and VAT obligations and so on. So companies' permanent establishment abroad is based on the tax treaty that's in place between Ireland and the other jurisdiction, and it's generally defined as a fixed place of business. But the question at the top of everyone's mind at the moment is, well, what does that definition mean for the everyday worker, and what does it mean for somebody in a management position? Because one of the most common ways to trigger a permanent establishment is through contract negotiations in a jurisdictions. So to manage that element, some companies are looking at issuing internal guidance for remote workers to prevent them from binding the company to contracts, or looking to put in place appropriate oversight. And I suppose it's not just the overseas position that needs to be considered for those employees who are working abroad. You also need to consider the Irish position, because previously these people would have been in Ireland, now they're abroad. So we need to start thinking about, does Irish PYE have to continue to be operated, or should it be turned off? And where Irish PYE does continue and there is a foreign withholding tax obligation, how do we manage that double taxation that's arising? So turning now to those employees who are back in Ireland, who would normally be working abroad, we now need to consider, well, should we start operating Irish POE? Do we need to put them on an Irish payroll? Should we be paying Irish social security? And then corresponding to that in the foreign country, well, they're back in Ireland, they're not in the foreign country, so do we still need to operate foreign withholding tax, or can that be adjusted? And where there's double taxation, how do we manage all of that? And I suppose the thing overriding all of that is, what does all of this mean for the individual employees? Are they paying higher taxes than they previously would have done before all of this started? And who's covering the cost? So companies really need to get on top of this now and consider what it means for my employees. What actions do I need to take now and in the future? Next slide, please. So the Irish Revenue provided some guidance very early on to deal with these challenges from an Irish tax perspective, which has been really helpful. So there is existing a guidance that says where an individual is prevented from leaving Ireland due to extraordinary natural occurrences, which couldn't have been foreseen or avoided, then the days that are spent in Ireland are not counted. So Revenue clarified that a departure from Ireland prevented due to COVID-19 would be considered force majeure. So those days spent working in Ireland are not counted. And you might have seen some of headlines on the paper talking about Revenue giving preferential treatment to tax exiles who find themselves back in Ireland. So that's what that piece is alluding to. But it has a lot wider application to employees in this case. For foreign employers who find themselves with Irish employees working in Ireland, normally Irish withholding tax applies where they spend more than 60 days in Ireland if they're coming from a DTA country, or 30 days from a non-DTA country. But Revenue have said in this case where they normally would not have been working in Ireland and they find themselves in Ireland due to COVID-19, then Revenue won't impose a withholding tax obligation on foreign employers. Also for Irish employments, in cases where Irish employers previously would have had POIE exclusion orders, so they would have switched off Irish POIE because the individuals were working abroad, Revenue have come out and said that the work being carried out in Ireland now as a result of COVID-19 won't impact on the POIE exclusion orders. There was also some welcome relief for cross-border workers. So there is a relief at the moment for those workers. So it's where individuals hold foreign employment outside of Ireland and commute back to Ireland at least on a weekly basis. And they qualify for specific tax relief. One of the conditions attaching to that is that they don't work in Ireland. And Revenue have said that if they find themselves back in Ireland due to COVID-19, and provided all the normal conditions are met, well, then those days present in Ireland won't preclude them from being entitled to make the claim for cross-border relief. Revenue also provided for the costs of assisting employees returning to the state, including payment of holiday and flight cancellations where the employee involved is integral to the business and was required to return to deal with COVID-19 issues. Next slide, please. Revenue also provided for extensions to reporting deadlines, which we've also seen across other jurisdictions globally. And finally, in relation to permanent establishments, foreign companies don't need to worry so much at the moment where they have individuals in Ireland that would not normally be in Ireland. Revenue have said that they will disregard that for CT purposes where otherwise they would have created a PE. And similarly, where individuals are present in another jurisdiction outside of Ireland, and they would have been present in Ireland, Revenue will disregard that also for corporate tax purposes. So there was a lot of very much welcome guidance in Ireland. Next slide. So turning now to other countries and how other countries have responded. Unfortunately, there hasn't been any real coordination between the different countries, and this is where the problem arises for Irish employers who have individuals who find themselves working in other countries. A lot of countries have provided some concessions. Some of them are quite time limited, and some countries haven't provided any concessions. So there's no real coordination. So just looking at the US and the UK as examples, in the US, they have provided that days won't be counted for residency purposes, where individuals would normally be non-resident, and they're allowing individuals to exclude up to 60 days. Now that was, I suppose, is a very effective measure initially, but at this stage we're gone beyond the 60 days. So there's a lot of question marks at the moment in the US, and Grant Thornton in the US are saying that at the moment there's no indications that that 60-day period is going to be extended, which could lead to implications in the US that need to be considered. Similarly, in the US, they also provided that where individuals are in the US and would otherwise be considered to create a PE, again, the IRS are allowing companies to exclude up to 60 days, provided that they were present in the other country before COVID-19 and there was a reasonable expectation they would have remained in the other country. Again, we're past that 60-day time limit, so there's a lot of question marks over what that means for the next stage in the US. In the UK, they have a statutory residency test, and similar to Ireland, the days spent physically in the UK as a result of COVID-19 won't be counted for their day count test. They also have extended self-assessment payments on account, which were due on the 31st of July. They've been extended to the 31st of January. On the PE side, they haven't provided for the concessions which we've seen both in Ireland and the US, and HMRC have actually said that existing legislation and tax treaties will remain in force, and that is what is relevant to the analysis. So you can see that there is different thinking in different jurisdictions. Which it was a welcome move was the extension of the IR35 implementation deadline to next year. That's going to have a significant impact on employers who engage individuals via one-man companies. So we've seen a number of deadlines pushed out, which has been very welcomed, but no real coordination between the different countries, which makes it difficult to advise employers. Next slide, please. So when we start thinking about what's next, there's still so much uncertainty, and it's unclear how long the employees we've spoken about will continue to work remotely in these different locations. We know in the US, for example, restrictions are to remain in place until the end of the year. What we're seeing really is shifting dynamics, and at the end of the day, companies still need talent in certain locations, and companies are now starting to explore virtual assignments, which brings with it a different set of tax considerations. It's going to be interesting to see how the various tax authorities respond to this in the longer term. At the present, the international rules in place are to deal with the unintended tax consequences as a result of force majeure, and a lot of the reliefs provided are quite time limited. And it's still unclear what it's going to mean on a longer term basis, and at what point do we start to use a different set of analysis. So just to conclude, there's still a lot of question marks, but given the costs involved in getting things wrong, companies really need to start now proactively thinking about the changing nature of their workforces at an international level and the actions that are needed to remain tax compliant. Thank you. I'll hand over to Debbie now.
Morning all. My name is Debbie Fry and I work as part of Grant Thornton's financial counselling team, and we look at financial wellness. This morning I'm going to bring you through the area of financial wellness and why it's an area that's been looked at by both employers and employees more. So just go to the next slide. If I asked you to sum up what financial wellness means to you, I'm pretty sure we'd get at least 20 different words. As to define how it relates to every individual is very different. And on the next slide here, we can see some key words that sum up what financially well means. Now, some of the words I suppose that are appropriate to me or what it means to me would be security, balance, power, freedom, confidence, control, understanding, calm, goals and future. Financial well-being relates to how we manage our personal financial circumstances and how we balance our current income and expenses, taking into consideration our wants and needs for the future. It's about having financial goals and working out a clear plan on how to achieve these goals. Financial wellness doesn't necessarily have to be about how much money you have, and in fact studies have shown that those high earners do report the same level of concerns about their finances as those with more modest earnings. Financial wellness and wellness as a whole encompass a number of interdependent dimensions such as physical, emotional, mental, social and financial, and each of these can impact on the others. Many employees at present will be having sleepless nights with the concerns of their financial obligations and the security around their income, and this in turn has an effect on both their physical health as well as mental. Wellness aims to enhance our well-being as people who can confidently manage their money and efficiently plan their expenditure are seen as being financially well. Are they immune from worry and doubt? Absolutely not. But they do have an understanding, at least, of their finances, and as such are in a better position to maybe plan and deal with the unexpected expenses that may arise. According to a recent Bank of Ireland survey done late 2019, over a third of our population is actually stressed about money. And given what we've experienced in the last 4 months, you can be pretty sure that that percentage has risen greatly. So if I first take employees and look at what day-to-day expenses most employees have, there's an array of costs that do apply. And on the next slide, we look at the outgoings that aren't discretionary spends. These are necessities, okay? But it's really important when reviewing one's expenditures that we're firstly very honest with ourselves on what we're spending our money on. And we're also open to see how changes can be made to make us financially well. When considering your financial circumstances, what do we look for? Well, it's important that we have a good grasp of your monthly commitments. Quite often when we ask a client, okay, how much are you spending on average per month? What are your outgoings? What is your fixed expenditures, your money that this is definitely going out of your bank account to cover bills? And 9 times out of 10, you're faced with a blank expression from somebody with an air of embarrassment that people don't know this thing. And these questions aren't designed to make you feel bad, but it's just to highlight the fact that how can you control your finances and understand your current financial position if you don't know where your money's going? It's also about looking at protection. For example, more people have pet insurance or gadget insurance than income protection. I have a cat myself, it's 15 euros a month goes on pet insurance. And actually when you think about it, you're going, I'm spending more on a gadget or a pet, and I'm valuing that more than maybe my own life. In how would I cope if I didn't have income? What is there a plan in place to give me replacement income? Does it make sense? No. But could the money be used better? Could it be used in a more tax efficient way? Yes. And there are many options available to help us along the way, such as retirement planning, where we get tax relief on our contributions, protection plans like income protection, where again, we get tax relief on our premiums. It's looking at your status of employment, going, okay, well, look, if you're self-employed and you have a regular life cover in place, well, you could actually take out pension life cover and get tax relief on the premiums, therefore saving yourself a bit of income. If you have a serious illness plan attached to your mortgage, which most people do because they take out their mortgage with the bank, and the bank do tend to wrap serious illness cover as part of the mortgage protection. But actually, when you actually look at the plan, it's about going, okay, well, look, is this plan actually appropriate for me? How much am I spending on it per month? And will I get a benefit from this? Or is there another type of plan that would give me a more appropriate benefit, and can it be done tax efficiently? So on the next slide, I suppose it's just to give you an overview of how we try to help, okay? How do we assist individuals? Well, our aim is to try to help them get an understanding and take ownership of their own financial affairs so that they can be realistic in their budget and set very clear, achievable goals. Education on how to maximise tax credits available and understanding payslips is key, as it gives employees a sense of empowerment in relation to their own financial circumstances. The area of pensions is one that we do focus on when we're looking at financial wellness, because we're all very guilty of not wanting to think about the future, and we often shy away of thinking about retirement and retirement planning, as there's a clear association with old age and something that's so far in the distant future that, you know, why should I worry about it? But in reality, looking at this sooner rather than later really puts you in a great position to be able to retire in confidence, and that knowing that you will have sufficient income. I like to call it my future fund, because at the end of the day, come retirement, nobody wants to be penny counting. And it's our time in our lives that we are likely to want to spend more time with those we love, doing the things we enjoy. But to do this, we have to have an adequate retirement income. Retirement planning is something that, as I said, most people are guilty of putting on the long finger. And there's always something else. And I myself was guilty of it. I have worked in the pension industry for the last 17 years, yet only 3 years ago, I seriously, shall we say, started looking at pension funding. And you might laugh and think, well, look, surely you know better, you work in the industry. But it's always very easy to tell other people what they need to do. It's always harder to do it yourself. And there's always been something else. This is a massive problem for our younger generation. You know, they're getting married, buying a house. They have really big commitments. And in the private sector, there's a situation that over 50% of the private sector is seriously underfunded from a pension point of view. They won't have the guaranteed pension that the public service get. And so, you know, they do need to pay attention to it. So we have to set plans that are realistic and achievable. Savings is another hot topic, I suppose, these days, given the bank deposit rates are desperate, for want of a better word. And it's considering, are there alternate options out there that can give you better value for money? It's not only about how much you save, it's also where you save it. And I'm all about diversification and not having everything in one basket. So when you're looking at the whole financial circumstances, it's really important to take a holistic approach. You don't put all your money into pension or all your money into savings, or all your money into a bank. You create a plan to make sure you're appropriately diversified and you have access to cash if you need it. It isn't about saving a lot of money. It's just about managing the money that you do have in the way that is best for you and your goals. So employees are not the only ones who benefit from the improved financial well-being of their employees, and there is a definite increase in morale in employees who feel financially educated. Employees who understand their financial circumstances are more likely to be engaged and productive, as they don't have the burden of financial worries weighing on their shoulders. And the concept of financial wellness in the workplace is quite simple. If you aren't distracted or worried about your financial problems, you are less stressed, healthier, and have a better ability to focus on your work. A recent survey actually suggested that nearly 50% of employees admitted to spending time in work dealing with their financial circumstances, and actually closer to 60% actually admitted that they really did want help in managing their finances. And this is where our workplace financial well-being program can be a good way to try to help your employees, give them the ability and the access to maybe some financial advice. And the right program can really help reduce the financial stress while guiding your employees through the various financial stages in life. Now, if we now look at how financial wellness can be facilitated, in essence, it really can be tailored to what an employer wants and what works best from their side and also the employees. And we would normally suggest a seminar to start off with to give an overview of some of the key areas to consider. And then for those employees who really want to take a look at it further and get into the nitty-gritty of it, a drop-in clinic or a one-to-one so that bespoke advice can be provided and assistance given to them, to those who really want to take control of their financial affairs. For executive level, I would probably suggest going straight to the one-to-one stage, where essentially we look at a 3-step process where we consider life planning, financial planning, and then financial advice. So in the life planning stage, we look at, okay, well, look, where are you now and how did you get to this point? What's the history? And also, what are your long-term goals? What's your investment experience? And what is your primary objective? So for example, when do you want to retire? Is it 65? Is it 60? Do you actually think you're going to continue until 75, 80? It just depends on the person themselves. So once we've established, you know, the history and what actually the goal is, we look at, okay, we'll look at the planning stage. Are you actually saving enough? Realistically, based on your current circumstances and with, you know, if all things being equal, things continue, will you be able to retire when you want to? Can you meet your goals? What about your family and your dependents? Are they going to be financially secure in the unfortunate event of your death? And are you taking on enough or too little investment risk in relation to your affairs? Once we've reviewed all that stage and we've gone into the planning part, the next part, I suppose, is looking at the actual financial advice and going, okay, well, look, based on everything here, this is the advice that we would suggest in relation to, albeit pension, investment, or protection. The very last point on it is to look at actual products and go, okay, well, look, what products do I have in place? Are these appropriate for me? Are they fit for purpose? And are they the most tax efficient options available to me? So to close, I just want to bring you through, I suppose, some of the tax efficient benefits that you consider for your employees. And when looking at the overall benefit packages, I think the times have changed in what employees are looking for, or else I'm getting older, so the people I'm talking to are looking for different things. And salary is not necessarily the be all and end all. It's all about the overall package. And as an employer, this can be something that you can really use to ensure that you offer staff a more rounded offering, and yet at the same time, you can get some tax benefits along the way. Under Irish legislation, an employer must facilitate a pension for any employee who wishes to avail of it. However, there's no obligation on an employer to contribute. However, contributing to a retirement account on behalf of the employee is a tax efficient way to benefit staff. There are various options, and on this slide you'll see the amount of different pensions that are available out there. But it's about finding one that's appropriate for your employment and your employees, and also that it's structured in the most cost-effective way. There is a consultation paper with the government at present over auto-enrolment. And auto-enrolment is in a few different countries in the UK and Australia, where essentially you have to, as soon as you join employment, you are in a pension, and then you actually have to make an active decision to opt out of it. Now, one thing we know is that state pension cannot continue at its current level. It's unsustainable. We have an aging population. So there is going to have to be some changes along the way as to how pensions are funded. With auto-enrolment, you are putting a bit of an obligation on the employees to actually make a contribution from the very early days in their employment. And so often now we talk to employees who are late 30s, early 40s, and they haven't started pension funding. So their time horizon to accumulate a pot for the other end is quite short. So another benefit that can be considered is life cover or income protection for groups of employees or key individuals. And the advantage of this is that you're benefiting employees with protection benefits, so that, God forbid, something happened to one of them, there's a lump sum benefit available to the family in the unfortunate event of their demise. Or income protection would be in place, and that essentially is to provide replacement income paid to them by the insurer if they're out due to accident or illness. Now, both these types of benefits can be taken out personally or through a company. The one thing I think people tend to kind of shy away from these is that, you know, they think they're really expensive to cover a group of employees. However, when they look at the scheme, they actually use an average age, average salary, so the per employee cost can be relatively low in comparison taking this cover out individually. So therefore, for quite an acceptable cost, you can actually give the employees a really big benefit in their overall benefit package. Now, again, risk benefits have nearly become the norm from an employer to offer them. And it would be one of the questions that I ask even my own friends or family when they're talking about a potential move, because obviously it's not just about one benefit, it's not just about a salary, it's about looking at the holistic approach, looking at everything, and ensuring, I suppose, that you are giving your employees the means to be financially well and helping them along the journey of working out their own personal financial circumstances, getting a plan in place, and then working out in the middle of it, okay, well, look, how do we get there? It's not a one-size-fits-all approach. It is tailored, I suppose, to the individual and to the companies, but it's something that is really worthwhile from an individual side to see that their employers, I suppose, will offer it and facilitate it for them. So that's it from me. I'm going to hand you back to Jillian now.
Thanks very much, Debbie. I have a couple of questions here, if you don't mind, just for the different presenters. Jane, one of the questions I have is, if my team member happens to live in Derry, but they work here in the Dublin office, and I wasn't able to let them into the Dublin office, they had to work at home, am I going to suffer tax in two jurisdictions as an employer?
Yeah, so potentially potentially at the start we were really grappling with that kind of an issue, the kind of cross-border issue. But the way that HMRC responded to that, so HMRC have said that they won't count the days that are spent working in the UK. So so for the moment, no, there's no obligation in the UK, and no action required. But that is for kind of on a short-term basis. So it remains to be seen. You know, we're kind of seeing cases where individuals say that person is in Derry and they quite like working in Derry, and maybe they've gotten used to it, so they now in the future they might want to spend a day or 2 a week up in Derry. So that's when the possible withholding tax obligation could arise in the future, when we get out of this initial phase.
Yeah, so we have to be very careful about, I suppose, the new working way that we're all talking about, that actually could also bring more taxes on employers unintendedly, because we want to do what's right, and we're saying, yeah, okay, there'll be more of a mix of remote working and office working, but actually it could bring a lot of costs with it. So we're not guaranteed HMRC and some of the other countries will continue the favourable tax of not looking at the days during COVID, but I suppose every country may come out of COVID at different times as well.
Yeah, and that's the real challenge, you know, when you're talking to companies. You know, every country is different. The rules are, it's quite good in Ireland and the UK in terms of what the authorities have come out with, but in some countries there's no concessions at all. So that type of working arrangement does create a withholding tax obligation for some countries. So it's really country specific.
Thanks, Jane. Mike, if you take that into account, we obviously have a plan around trying to entice people back into offices. Some companies come out very loudly and said, look, there'll be no returning to work this year. A lot of the American companies were very quick off the mark to say, we probably won't see you till next year. That trend seems to be changing a bit if the reports are to be believed. Are you seeing that?
Yeah, so I guess, there was some great excitement and then relief that business continuity was able to happen and people were able to work from home and businesses were able to continue to carry on. But what companies and in particular managers and senior management are starting to notice is they're losing a little bit of, I guess, what you call the buzz or the collaboration piece that was in the office. And so they are looking to really start to encourage people back into the office at least a couple of days a week in order to have some of those meetings, obviously with a social distance hat on and following all the COVID protocol and all that. But what they are starting to see is there's a bit of fatigue coming into moving into, the dining room of the house every morning and working for 8 hours in the same place and seeing the same faces on the same screens rather than maybe being able to go in and have, an informal coffee with somebody. So what they're starting to see is not necessarily a dip in performance at the moment, but they're starting to see a dip in motivation and the collaboration and creativity piece. And they're looking to encourage people back into the office to have that kind of, person-to-person human contact that then kind of rages the energy and whatnot. Now, having said all that, there are some people who would have genuine concerns about coming back into the office if they have a family member who's maybe vulnerable to COVID. We seem to be, at least in the country, starting to think through what childcare arrangements in school looks like. So I think that's going to become a bit easier in the next 6 weeks. But I do think there is a bit of a concern that as we go into September and October, and this is the new way people are working, that there's going to be a dip in performance. And so therefore, organizations are encouraging individuals back into the office to kind of raise the energy a bit and to be able to collaborate face-to-face a bit more.
Great, thank you. Debbie, just one of the things I suppose we've seen with some of our clients where they're trying to look at cash flow, and indeed the employees themselves are looking at cash flow, where they've said, can I stall my contributions? So say companies where they've had to use the wage subsidy, can we stall it? Will it impact on my pension? Significantly?
Look, and I think this is something that's come up quite a lot. And yes, absolutely, you can stall it, but you do need to consider that it does actually come back to the contracts of employment and what you have actually said in them as to your obligations. So from a pension side, it is possible to stop contributions, start contributions. If you have the wage subsidy scheme, the employers, you pay on the lower amount that you're actually paying them, and it's absolutely no problem. But it does come back to contracts of employment. For example, only a friend of mine, they they got pay cuts. However, what actually happened was the company had to actually honour their pension contributions at their salary as of, say, for example, the 1st of February, because it was in their pension trust deed that pension contributions were remitted based on the salary as of the 1st of February. So therefore they got stuck in that, okay, they had pay cuts and they were given, and obviously the income was less for everyone, but they still had to they're still obliged to pay pension contributions based on the higher amount. So if you are looking at it or have done it or anything like that, I would suggest that just make sure it's communicated as well to the employees, make sure they're aware. So don't just stop people's contributions, reduce them or anything like that without communicating it clearly, because most of the time, if you're open and honest with your employees, you communicate it clearly, you'll find employees are quite reasonable and they will understand. I think everybody understands that it is extremely challenging times at the moment. So whether that is an agreement, look, we're going to have to stop pension contributions for the next year, whatever it is, as long as it's communicated well to the employees and you take on board their feedback in relation to it, I think you're going to not be into a situation of having employees coming back at you on it.
That's really interesting. I wouldn't have thought of it being a percentage of what could in some ways be a historical salary.
It is, and that's the problem, is that a lot of pension trust deeds are historical. They haven't been updated, and for example, this is actually like an financial advisory firm. So they are into a situation now. They are honouring everyone's pension contributions on a salary that they're not getting, because of it.
Yeah, Jane, just totally off everything you spoke about, but a random one here. Most of my friends and colleagues, they got really excited because they read the headlines in the Irish Independent. Employers to pay $3.20 tax-free to all employees per day. Employees allowed to claim huge rebates on their tax for their utility bills. Are you going to burst my bubble? Is that really the case?
Yeah, we've been getting a lot of questions on that, and it's made all the headlines. So I suppose what Reverend you're saying is that employers can pay up to $3.20 a day tax-free. Some employees got very excited and thought that employers had to, that it was an obligation. Unfortunately, it's not. It's a discretionary. So if the employer decides to pay them something towards a contribution towards their utility bills, it's $3.20 a day that's tax-free, and anything above that will be taxable. And then I suppose, for, a lot of companies aren't making that payment. So where that's the case, and individuals, they're incurring additional electricity, heating bills at home, it's just important to keep all the receipts, and you can make a claim through your end of year tax return. You're going to have to, you obviously can't claim for your full heating bill or electricity bill, but a proportion of it. And Reverend, you were saying that they would accept maybe 10% of the building could be attributed to the Home Office. So that it can be done that way. But it sounded great, but it's very small when you actually start crunching the numbers.
I was going to say we did one where we had a look at it for what the revenue we're permitting, and I think it was working out that you might get €16 of a tax credit. It seems like a lot of work for that €16.
Yeah, absolutely.
Debbie, I know on a lot of our clinics where we had been out with clients and we were doing the financial wellness workshops, and Jane and yourself would be out with them, I think it was surprising how many people didn't know how to read their payslip, or even had actually looked at their payslip.
I'll be very honest, I'm one of those people. Like, I don't have a notion about it. And it really is an education piece to actually understand going like, and I know in some of the ones I came up with, it was questions, are you jointly assessed, are you singly assessed? People were like, no idea. And you're going, okay, or do you have, dependents, or people had carers, and all this stuff that nobody had any idea about. So I learned a lot at it, but I do think it's really, really important.
Yeah, I think, I suppose it's fair to say a lot of people, they don't even know who to ask, or they don't want to be asking the payroll person because, well, I certainly in here, I always find it interesting, the amount of people who don't know or understand it. But it's like, well, I work in an accountancy practice. How can I go and say that? How can I go up to somebody in tax and ask that? But the reality of it is, if the money is the same every week in the bank, I suppose people tend not to ask the question.
And the problem is like even personally myself, I came back after maternity leave, and after around a year, I kind of couldn't understand. I was like, I'm not getting it. Like, why is it? And actually what had happened was, I hadn't done anything, my husband hadn't done anything, but Revenue had moved all my tax credits to my husband automatically.
Yes, that can happen.
Yeah, so, and I was like, I rung them over it and was like, did I say something? Did he actually, more to the point, not me? And it was like, no, somebody just, we just updated it. And I was like, okay, now we'll change that one quickly back. But it's it was literally fluke that I figured that out. Whereas if I'd understood my payslip, I would have caught it really quickly.
Yeah. Okay, well, I suppose I'm conscious of the time and trying to keep it to the time. So I'd like to say thank you very much to my three speakers and to everybody for joining in today and giving us your time. If there is any questions, our contact details are there. Please do let us know and we will endeavour to get back to you with an answer, or at least point you in the right direction if we can't answer the question ourselves. But thank you very much, everybody.